Hello and welcome to Crypto Bibles News. I'm Oliver, and in today's news we're going to be looking at the following stories. Did conflicting reports about Evergrande defaulting cause Bitcoin to tank? Warner Brothers to launch Matrix NFT avatars with Blue Pill and Red Pill. Should Zuck lead us to the Metaverse? Crypto leaders weigh in. UK crypto derivatives ban fails to protect retail investors. Fears about the stock market and Tether's reserves have also led to some to believe that Bitcoin's price could be in trouble. Conflicting news about whether Chinese property giant Evergrande has defaulted on its overdue loan payments emerged just before Bitcoin's recent price crash. Evergrande Group is China's second largest property developer and is in debt for roughly $300 billion. Wow, that's a lot. There are fears that its collapse could spark a wider financial crisis. 2 minutes after Evergrande's payment was due, the Deutschmark screening agentur issued an announcement on Wednesday at 4 p.m. UTC time, stating that it was preparing bankruptcy proceedings against Evergrande. 2 hours later, at about 6 p.m. UTC, Bitcoin began its hours-long pullback to $62,800. Media outlet reported about 45 minutes later that Evergrande had missed a payment on its outstanding debt, which was due on Wednesday at 4 p.m. UTC and defaulted. This was around the same time Bloomberg reporter Alison McNeely tweeted, "Contrary to what you may have heard on the internet, Evergrande did not default today." William Fong, senior trader at Australian crypto asset investment platform ZeroCap, Evergrande has not officially defaulted on any of its offshore debt obligations in the international USD bond market. Bottom line, $148 million is nothing compared to the $300 billion outstanding debt of Evergrande, but it does create a concern for the $100 billion outstanding keep well structured offshore bonds by Chinese SEOEs, state-owned enterprises and corporates. Fong believes that a bailout for Evergrande will not come at any time soon because Chinese regulators were the initiators of a cap aimed at overexpansion in developers' leverage, adding, "This has created potential contagion risk across the entire property developer space and has expanded towards financial institutions and industries dependent on the sector as well." Some believe Bitcoin's price could also be at risk from a stock market meltdown and due to fears that nearly half of Tether's reserves are made up of commercial paper, amounting to nearly $30 billion. This is enough for the Financial Times to place Tether among global giants in that category. However, Tether has denied that it holds any commercial paper from Evergrande, though it may be exposed to Chinese companies. Commercial paper is a corporate debt note with a short expiration date of usually under a year. What are your guys' thoughts about the Evergrande story? Let me know in the comments below. Warner Brothers to launch Matrix NFT avatars with Blue Pill and Red Pill options. This sounds exciting. Warner Brothers, the American multinational mass media and entertainment conglomerate, has announced the launch of non-fungible tokens collectibles for the upcoming film The Matrix Resurrections, after dropping official Space Jam NFT collectibles. The Matrix NFT program will start on November 30 as Warner Brothers plans to drop 100,000 Matrix Resurrections NFTs. You take the blue pill, the story ends. You take the red pill, you stay in Wonderland, and I show you how deep the rabbit hole goes. The entertainment giant Warner Brothers is knee-deep in the non-fungible token industry these days after launching the official Space Jam NFTs with the Miami-based firm Nifty's Inc. The NFTs stemmed from the recently released Space Jam: A New Legacy, which starred a cast of famous Looney Tunes characters and the NBA star LeBron James. Warner Brothers has joined a big number of entertainment firms like Fox, Lionsgate, Dolphin, and Viacom CBS. The entertainment companies WWE and UFC, firms that are focused on specific sports such as professional wrestling and mixed martial arts, have also jumped on the NFT space. Now, Warner Brothers is working with Nifty's to drop NFTs for the upcoming film The Matrix Resurrections, which is due to be released on December 22nd. The official Matrix NFTs will be avatars of people inside the Matrix. The avatar NFTs will drop on November 30th, but on December 16th, owners of the base avatar will be able to take the blue pill or take the red pill. If they take the blue pill, NFT avatar owners will remain in the Matrix, but if the red pill is taken, the NFTs will transform. According to the announcement, Nifty's and Warner Brothers will continue to keep the Matrix NFT community going with frequent challenges. The upcoming movie, The Matrix Resurrections, will be released 18 years after the last film, The Matrix Revolutions. What do you think about the upcoming Matrix Resurrections NFT collectibles? Let us know what you think about this subject in the comments section below. Should Zuck lead us to the metaverse? Crypto leaders weigh in. In order for him to have a clean slate for Meta, he must step down and he must have a new CEO to run it, said Jenny Tarr. Crypto leaders are divided over whether Mark Zuckerberg should lead Facebook into the metaverse, with hlrLU Jenny Tarr saying he needs to resign if Meta is to succeed. While Animoca's Yatsiel said Zuckerberg is the only one who can drive the company forward. Ta is the operating officer of non-fungible tokens NFT platform developer hlrLU and said that Zuckerberg needs to head off lawsuits and protect the company's image by relinquishing his role as CEO. But the co-founder and chairman of blockchain game and virtual property developer Animoca Brands, Yatsiel, said that Zuckerberg is a force of nature who can make Meta's vision a reality. But he hopes he embraces a decentralized model. The comments came in light of Facebook's recent rebrand to Meta, in which the firm is aiming to provide a platform for creators to build virtual online businesses and launch its virtual reality hardware business named Reality Labs, on the way to creating the metaverse. Tarr said recently that regulatory scrutiny aimed at the CEO over Facebook's data mining, privacy and content policies, it would be better if he stepped down to provide Meta with a clean slate. She went on to draw comparisons with Bill Gates and Microsoft in the early 2000s. Bill Gates, when he was still the CEO of Microsoft, he was a monopolist. So the government went after him hardcore. Lawsuits after lawsuits until one day he said, forget this. In order for me to save the company, I need to step down. And guess what? It worked. Tarr suggested that figures such as Zuckerberg, Gates and Jeff Bezos never actually want to let go of the throne, but will do so to protect their wealth and repair their firm's image if required. Mark Zuckerberg's wealth is Facebook, not the metaverse. The metaverse has proven to him nothing yet. In order for him to have a clean slate for Meta, he must step down and he must have a new CEO to run it. While Xiao isn't necessarily a fan of Facebook's metaverse play either, he thinks that Zuckerberg needs to remain at the helm. Xiao described the CEO as a force of nature who is more focused on getting his projects across the line than receiving monetary compensation at this stage. This is the irony. I think that it needs Mark Zuckerberg because it's a founder-led organization, right? You know, say what you will about all the things that Mark may have inadvertently done. He is brilliant. He is one of the smartest people in the world. He's going to drive the organization in a mission-led way. Where Xiao sees an issue, however, is whether the organization will be able to go with him in the speed that he wants to and also spar with him appropriately. Xiao also thinks that Meta and Zuckerberg need to reconsider its current centralized business model if it wants to truly create an open and successful metaverse. I think Facebook is very much facing an innovator's dilemma that might counter what Mark would like to do. Speaking more broadly, Tarr likened the current state of the metaverse to the initial adoption of text messaging when phone calls were standard. The 5% of the world who really knows what the metaverse is are like the ones who were first using text messages 20 years ago. Xiao thinks that mass adoption is coming soon, as the conversations about the space have shifted from a niche topic to something that is reaching a mainstream audience. What are your thoughts, guys? Should Mark be part of Meta or not? Let me know in the comments down below. UK crypto derivatives ban fails to protect retail investors. A recent opinion post by Ian Taylor from Financial Times said the valuation of cryptocurrencies has increased dramatically in the past 12 months, as has their adoption by investors around the world. Individuals as well as institutions, until a few years ago, most retail investors would have required the use of a broker or investment professional to handle their investments. Today, consumers flock to apps and platforms that enable them to make direct investments on their own, without any intermediary, both in traditional finance assets and increasingly in crypto. In a sign of how accessible digital assets have become even to retail buyers, US regulators last month authorized the country's first crypto derivative ETF for Bitcoin, the most popular digital currency. In giving permission, officials followed their counterparts in jurisdictions as diverse as Canada, Germany, Dubai, and Brazil. And where is the UK in all this? Lagging behind is the answer. Far from preparing to join the global drive in giving retail investors good access to crypto products under the safety umbrella of strong regulation, the Financial Conduct Authority is sticking to a ban it introduced last January, prohibiting the sale of crypto derivatives to retail customers. The restrictions do not really work because investors can still buy such derivatives abroad or through roundabout ways outside the regulator's control. Far from enhancing investor protection, the measures risk compromising it. Instead of boosting Britain's position as a global financial centre, an unduly cautious approach to crypto limits the UK's ability to develop a share of this fast-growing, revolutionary market. Certainly, the FCA is right to focus on investor protection and to be concerned that such a rapidly developing market poses dangers to investors, but it needs to adapt its heavy-handed approach to a more flexible policy that can still offer investors the required level of safety. Post-Brexit, the UK is strategically positioned to take a proactive stance on retail crypto addition, but has instead taken a wait-and-see approach and consistently raised concerns about consumer protection, which at times has been inconsistent with its own research. The FCA published a survey this year noting that the majority of crypto asset owners are genuinely knowledgeable about the product. They're aware of the lack of regulatory protection and understand the risk of price volatility. However, when the FCA in January announced its ban on the sale of crypto derivatives to retail clients, it said that retail consumers can't reliably assess the value and risks of derivatives like contracts for differences, CFDs, futures, options, and exchange-traded notes, ETNs. The FCA's reasons included concerns that consumers did not have a reliable basis for valuation and that retail customers had an inadequate understanding and lack of clear investment need. There is an obvious contradiction here between this statement and the FCA's own survey. The regulator's decision was largely viewed by the industry, which advocated a more balanced approach involving protective measures such as placing a ceiling on leverage, as unnecessarily cautious. It's difficult to understand who this decision protected, given that UK customers are still able to open offshore accounts which offer derivatives trading with up to 100 times leverage. I believe most do so with their eyes open. Retail investors entering the complex world of crypto and digital assets are required to do their own research, and many are doing so. The FCA derivatives ban seems strangely misaligned with the UK's historical successes as a fintech hub and the government's commitment to be a competitive and innovative jurisdiction for financial services. Even in the EU, often seen in Britain as a bureaucratic monster, slow to keep up with financial pioneering, there are no similar bans, nor in the US or most of Asia. Last week's move by the US authorities only emphasises how isolated Britain risks becoming. In fact, the US Commodity Futures Trading Commission has been overseeing regulated crypto derivatives markets for nearly 3 years with products that offer a reliable basis for valuation. These markets are accessible to retail as well as professional investors. In a welcome development, the UK government has consulted on proposals to bring the promotion of certain types of crypto assets within the scope of the existing rules, in an apparent effort to increase information flows and transparency. The regulator also recently launched a new Invest Smart campaign aimed at helping consumers making better informed investment decisions and to create risk awareness, especially for younger crypto investors. The FCA is also researching the possible inclusion of crypto assets in the high-risk investment category available to wealthier and properly advised investors. This includes other such assets as non-readily realizable securities, peer-to-peer agreements, and speculative illiquid securities. Crypto UK works closely with the FCA and supports initiatives designed to educate consumers in evaluating risk and highlighting crypto-specific investment nuances. However, there is a fine balance in protecting the vulnerable while acknowledging the growing demand for regulated crypto products from well-informed retail investors. Even with regulatory barriers, UK retail customers' appetite for crypto continues to grow. The FCA estimates that the number of consumers holding cryptocurrency has risen from 2.3 million in the 12 months to June 2021, from 3.9% to 4.4% of adults in the UK. We should strike a regulatory balance for crypto investing that mitigates risk adequately, but does not stifle the many societal benefits crypto can bring to retail investors, not least the opportunity to create considerable wealth. What are your thoughts about that? Let me know in the comments below. So that was the news. Please don't forget to hit that like button, subscribe down below to Crypto Bible, and don't forget to turn on the notifications button so you never miss any of our new videos. Join our Discord group, and you can find all of our other social platform links in the description below. Leave your thoughts in the comments, and once again, thanks for joining us today.